at the barista today.
Oh yeah, we at the barista today. Today we at the barista. I said I'm gonna take it up a notch, and I'm gonna put a different location up in here today. Look, my bag. I thought I was situated, but I was too busy playing on Amazon.
That's what cats do now. That's what cats do now. You know what I'm saying? When they got a little downtime, you know what I'm saying? They go shopping on Amazon.
Oh yeah,
straight to the front door.
I had to go check out. Look, I'm shopping for stuff I don't need. You know what I mean?
Yep. That's usually how it goes.
You get started on one, and then you click. Oh, well, you know what? And I need a flashlight. And you know what? I got all kind of stuff up in there. I said I will say, I got one good rule that after I get all of it on there, I go before I hit click to go. I go back and go through all of them and then kind of eliminate. All right, I don't need that. All right, I don't need that. So usually instead of having 100 things that I don't need, I get down to about 20 that I don't need.
hey, and a lot of stuff you probably just gonna use once and then put it up in the shed for a while.
Yeah,
Like, hey, you know what? This is you got a home project or something, man. This would be nice if I had such and such. I need to order that. Be the only time that you use it.
Yeah. But how things been going good with you, man? And everything going good with you this week?
Man, everything's been going good. It'll be going a lot better, you know what I'm saying, if rates wasn't creeping up here over this past week, 2 weeks, week and a half, 2 weeks or so. And they starting to creep back down, but a little bit of uncertainty and volatility in the market, you know what I'm saying? You know, from a lending perspective, you know, the volatility means we're going to go with worst case scenario. So we're going to hold steady until it figures out, the market figures out what it's going to do. Then we're going to make moves.
Yeah. Well, I'll tell you what, I'm seeing it on this end a little bit too. But what I you know, like I'm looking, we're giving the good goods. This is the outtake part of it that I'll be doing at the outtake. But, you know, we might have to come back and revisit this in the conversation. But you know, whenever it gets kind of they don't know what to do. You know what I mean?
Right.
Rates are going up. That's not normal to have a 2.5% interest rate, y'all. I'm trying to get y'all to understand is that, you know, you almost feel like you got to get it while it's there. You know what I mean? And then overall, you're still going to be in a good shape. You know what I mean? Whether it's 2.5%, 3.5%, 4.5%, whatever. The only difference is you might not be able to get as much house because that might be $50, $100 for each jump. You know what I mean?
Right.
So that's just change. You know, or you just come to the table with a little bit more money. You know what I mean? Mm-hmm. And that offsets it too. So, you know, I think it comes back to educating, you know, but, you know, I know what you mean. Everybody kind of get their hair in a knot for a minute and they be like, you know, they start holding their breath, you know?
They start, and the thing is that what people don't understand is y'all have been spoiled. You know what I'm saying? They've been spoiled. They start to see these twos. I said, ooh, when they get to these twos, it's going to be hard to get back to the threes. So now people see three, they're like, oh, that's kind of high. I'm like, high? That's still pretty damn good. Like, what do you mean?
Oh, man. You know, I think in the big scale of things, it's going to come down to, just like anything else, supply and demand. You know, when we get some more supply, some more inventory out there, and people feel better about putting those houses on the market, you know, at least coming from the real estate perspective, I think interest rate ain't gonna even play a role as much anymore. You know what I mean? I think it right now it's hot because you're on one side, you see the interest rate creeping up in their mind, right?
Yep.
And then it's only one house for every 7 people. You know what I mean? So they're like, oh my gosh. So they almost kind of taking it to the next notch. Whereas if it was 20 houses out there, you know, at the end of the day, you know, like I know, you find the right house. Okay, I don't care. Just let's figure out what we need to do to make this monthly work in my budget.
Right.
You know what I mean?
Right.
And we'll get it done. Do I need to put a little bit more money down? Do I need to get a grant? Do I need to, you know, you figure a way. You know what I mean? At the end of the day, I mean, let's be real here. We ain't talking going from 2.5% to 7%.
Exactly.
We saying from 2.5 to 3, 3 to 3.5. You know, we moving up at 1/4 to a 1/2 inch. You know, half a point. You know.
Oh yeah. You know what? I told this example. I was talking to somebody the other day. You know what I'm saying? And I gave him this metaphor, and it rings so true. Is that, you know what I'm saying? You know, me and my wife invest in stocks, right? So we were looking at, when the whole COVID thing started happening last year, you know what I'm saying? We were looking at the, which actually, you know what I'm saying, we ended up seeing it till late, but the Zoom stock ended up skyrocketing.
I missed that one too.
It was $60-something a share, right? You know what I'm saying? And $70-something a share. And then next thing you know, it skyrocketed to $150 a share. Right. Mm-hmm. So then at this point, we're looking at the stock when everybody else looking at the stock. It's like, man, this is 100% return already on the thing. You know what I'm saying? We done missed the boat. Yeah. We done missed the boat. You know what I'm saying? So we choose not to invest in any of those stocks. Mm-hmm. But now here we are just about a year later, you know what I'm saying? And the stock has doubled again.
Yeah.
So, you know what I'm saying? What I tell people is that it's the same exact thing for interest rates. You ain't got to be on the boat when it first starts. Just as long as you get on the boat. That's the biggest thing. Exactly. So, you know what I'm saying? Even if you miss the twos, the threes is still good. Get on the boat. Because you're still going to be able to take advantage of a low interest rate that you're going to have for the next 20 years or 10 years or however long you're going to be in the house. And your payment's still going to be low.
Yeah.
So don't miss the boat for sure.
Well, you know, the part that I think that people don't realize that even, let's say, down the road, they decide to rent that house. You know what I mean? Yep. They say, all right, I want to move to my new place. At these interest rates, you're going to outpace the rent rate of the property over time. You know what I mean? More times than not, you're going to be at a point where, you know, you might be paying $1,500 a month, right? Yeah. Well, then you say, I'm going to keep this house. You know, the interest rate is too low. I'm just keeping and rent it out and buy my new house, buy my dream house. Even if you kept that house, 7-8 years from now, $1,500 in rent, you're going to easily be at, more times than not, I mean, you're going to be pretty close to where you at or more. You know, just from normal appreciation and normal growth in the market. So, you know, but they don't understand that right now because in many cases people are just buying their first house, so they just trying to figure it out as they go. You know? You know?
I mean, you're saying people just have to understand that it's not many stories where you hear somebody say, "Man, I bought a house back in 06." And then, you know what I'm saying, I sold it 10 years later at a loss. You know what I'm saying? Yeah. Like, people are selling houses now and making grand theft money. Like, you don't understand that. Like, there's nothing to sell if you're renting. There's absolutely nothing to sell. Yes. So if you're doing good in life, you know what I'm saying, and you have your own home, you can chunk a little bit more towards that. I'm going to pay down this. I have an extra $100 this month. I'm going to tuck that towards my mortgage. Go ahead and start trying to pay it down fast. You know what I'm saying? So I can have more equity for when I actually get ready to sell. You can't do that for rent.
No.
You tell your landlord, you know what I'm saying, hey, look, I'm going to give you an extra $100 this month because I'm doing good. Can I get that back at the end and see what they tell you?
Right.
That ain't going to happen. It ain't going to be nothing to show for it.
Well, and then I go back to the saying we said the other day, you know, a couple of weeks ago when we was talking on the video, we was talking about right after the freeze, all the pipes busted and stuff like that, right? You know, I look at my son, who's still living with me, by the way. Well, my point, you know, I don't mind that they here. I love that they here, but you know, my point.
Hey, you know how we is as young adults. You know what I'm saying? We got to ride the gravy train as long as we can.
Yeah. You know what I mean? And,
we all been there.
And it's funny because I listen to my daughter because my son and his dogs and his girlfriend, they kind of took her room, right?
Okay.
You know what I mean? And then remember my office, my wife's office, that's where the pipe busts. So all the carpet's out of there. There's a hole in the roof. You know, all that stuff. We ain't finished that up. And then I got my office, which we ain't got nothing in here but a desk, my, you know, bookshelf, stuff like that. And so my daughter's kind of been sleeping on a air mattress. right?
Yep.
Or sneaking into mom's and daddy's bed and scooching daddy on the couch. You know what I mean? And she thinks she's slick too. She get up there and be doing this. Like you ain't sleep. You just laid down because she knows she pulling my heartstrings, so she know I'm be like, oh, just let her sleep. She got school in the morning. Da 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 da. I'll just go out here. You know what I mean? I'll figure something out, right? And, but you can tell it's weighing on my daughter, who is I don't want to say she's spoiled, but she a little spoiled in regards to stuff she basically the only child because she's the youngest, right?
Right.
And so she like, okay, when is Jordan going back home? Cause she want her room back.
Want her room back? Yeah, of course.
That's her space, And I said all this to say this is that the frustrating part is, and my son's a renter, and he's not an owner yet. And as a renter, he has to just wait until they're done. Like he has no control over it. You know what I mean? Like, whereas for me, like I could have did this a month ago. I could have did this 2 weeks ago. Only reason why I'm waiting is for the insurance stuff. For them to adjust to get out here, take their pictures, do their stuff.
Right.
And now they just did that the other day. I'm like, I done already made phone calls. Like this will probably be done within the weekend. You know what I mean?
Yeah.
I don't have to wait for nobody. I ain't got to, you know what I mean? I'll get my check from insurance when they get it to me. You know what I mean? But I'm going to go take care of this. Whereas, as a renter, and I'm hearing this story more and more about renters being displaced. They stand with the family. Some of them was at a hotel because just the house is not livable. You know what I mean?
Right.
I mean, when you think of my son's situation, his living room, kitchen, and hallway, all the ceilings is down. You ain't got no carpet on the floor, which we can go all in. We might have to have a conversation about renting and why people need to get out. Because I was just telling them the other day, they talk about, well, that's livable. What do you mean that's livable? Who wants to live on a cement floor with carpet packs and really?
Right.
Like, you think that's okay to be, you know what I'm saying? It's kind of like that logic. I mean, I get it. I'm not trying to hate on renter owners. I get it. That's a business for them and they got to survive too or whatever. But at the end of the day, it's your responsibility as an owner to do this in a timely fashion. I mean, we're going up on 3 weeks now. We'll be a month next week. You know what I mean? And he's literally been out of the property, but you still want rent. You still want the full rent because you believe FEMA can take it, but you want the full rent even though he ain't been in your house for a month. That don't make sense to me.
None.
As a regular person, as a real estate agent, you know what I mean? Sometimes it just kind of throws me like, wow, that's crazy,
Nah, it is. I mean, it's one of those things where ownership is not going to fail you.
Yeah.
That's for sure. You know what I'm saying? And then we just don't preach it. You know what I'm saying? We actually walk the talk. You know what I'm saying? Like me and you, we own our own houses. And then when we talk to our loved ones, we talk to them about trying to get their own house.
Yes.
Now, we know that everybody is in different stages of life. Things happen. You know what I'm saying? You may not be in a position right now to where, you know what I'm saying, you can actually purchase and own a property. But we're talking about start thinking of the mindset now of what you need to do to start preparing yourself to buy a house in 6 months or a year instead of 10 years and 15 years. Those are years that, you know what I'm saying, of being able to build equity and pay down the actual debt that you're not going to be able to get back. So we don't want to waste that time. We want to take high, efficient use of that time, essentially.
Yeah.
Think of that as your secondary 401k. And most people don't even think of a 401k at all.
Well, and look, we'll keep it in generic terms. Think of it as a savings plan a savings account that you really can't touch, that you literally, it's different when you create a savings account and I remember being young, I set up a savings account along with my checking account, because you usually get one free, you get the extra one free, right?
Oh yeah.
Back then, and I never put money in the savings account, or even when I did, I'd throw a little bit in there. But the moment I need it, or the moment I need, oh, you know what, I'm gonna go out. I do got that extra money in the savings account. I just pull it on out, and it make it useless. It would be usable for the time, but it couldn't grow. Whereas when you think of houses and ownership, like we've been saying, that is a savings account. You can't go get that equity out easily. You know what I mean?
Oh yeah.
Like really, the only times you getting it out is one, you either selling the property, or two, you refining the property and you pulling it out.
Yep.
But even then, that's a process. Like you got to make sure you got ducks in order. It's gonna take a little more time to get that out. That's what you want, because at the end of the day, you might say, "No, I don't need to do this right now. It's not. I don't have enough in there." Which will then divert you to maybe 5-10 years down the road. Now you got 10 or 15 more thousand in there. Maybe now you got a bigger chunk of money that you probably wouldn't have had if it was easily accessible. You know what I mean? If you could have got it easily, you probably wouldn't have it.
100%. And then it's one of those things where if you got bad habits, you're looking for excuses to do what you say. Transfer that money out of the savings. It's just like, you make these excuses, instead of making these excuses about why you can't touch that money and building habits about why you can't touch that money. It's like, oh, I got to get it because, I got to do X, Y, Z. And, I'm in a bad position if I don't do X, Y, Z, whatever the case. But when you put that, like you said, when you put that equity or put that money inside a house, it's not so easy to make excuses, go ahead and pull it and then spend it on something. Like you can't touch that thing. Like it's gonna be a while before you even can think about trying to touch anything when it pertains to that house, which is a good thing and a bad thing. Because you obviously want to be able to have a certain amount of savings just in case. You don't want to chunk everything that you got towards the house and not be able to get it back out in case life does happen and a legit emergency actually comes up.
Of course.
So you don't want to chuck everything in, but you want to be able to start building good habits and have something to where it's a vault. You put it back in, you put it in, it ain't so easy to get that thing out. And that's going to help you in the long run. You're going to be very appreciative of that.
And that's what I was about to say next. I was about to say, when those foundational pieces in life happen, college, kids getting married, retirement, what I mean? The things that we don't put in the forefront when we're young per se, right? But as you get older, you start to think more. As your kids get older, you're like, oh, I got a daughter. She's about to get married in 2-3 years. Do I got some money? You know what I mean? You start thinking of those little, I wasn't worried about it. I had 2 boys. I was like, okay, I mean, I'm gonna have to stack a little bit just in case, in case they need it, But at the end of the day, you know how it is. The tradition is that the father of the bride takes care of that stuff, right?
Right.
So, but now I got a little girl. I started thinking a couple years ago. I'm like, 15 years, I might have to,
It's like I might well start preparing now, having a little old wedding.
And look, you know what I said in my mind? I said, I ain't helping the matter because, she already get what she wants, so I can just hear her coming up to me. Well, Daddy, this is what I want, and it being so like we doing a wedding for the Kardashians or something. You know what I'm saying? Oh, I want the. You remember the Tyler Perry movie? They had the people up like angels floating.
The angels hanging up from the sky. Hey, your daughter gonna be like, Daddy, I want a blank check. I want a blank check. I just had a wedding of my dreams.
That's
invite 500 people.
That's what I'm saying. So, that's the other part that people got to really, I'm hoping that they start to get from some of the stuff we saying, is that we talking about right now and today, but we also talking about tomorrow and what this could do for you in your future. In the right circumstances and things like that might happen and come down the road.
the way I want people to think about this is, as you get closer to retirement, your biggest expense is going to be where you live and where you stay at. Imagine if you jump on it early and then you're able to get your living expenses taken care of. Now you started 30 years ago, your house is paid off. And now you don't have an expense for where you're going to live. If you think rent is expensive now, wait until 30 years. Imagine what rent is going to be. And I can promise you Social Security is not going to be where, you know, you're going to be able to sustain the type of life that you're probably living right now. So if you can actually eliminate your living expenses altogether, you start now, and the only thing you have to do back in the future, when you take care of your mortgage, is all you got to do is pay taxes, and all you got to do is pay his insurance. That's it. That's the only expenses that you have. I guarantee it's going to be a fraction of the cost as if you had to go out there and rent a house, or if you had to go out there and rent an apartment, or you're a burden on your kids because now you can't afford to live anywhere else. You can't afford to do anything else. So now you're begging your daughter, your son, or whatever, let me kind of throw myself into y'all's situation. And now you over there giving your opinion about something that you really should be staying in your lane on, and you causing friction in the family.
You know what I'm saying? You know what I'm saying? Trickle down effect.
All because you didn't prepare yourself for the future. For the future.
And I think to tag on to that is, I think everybody as they get older, you still want some level of independence. You know what I'm saying? And where if you own your own home, even if, you know, even take it out of the box of living in the property. Say you don't live in the property no more because maybe medically you need to be around somebody, you need to be in another place, or you need to be with family, right? You still could either rent that house, and if it's owned free and clear,
income.
That's income. Right. You could do a reverse mortgage if you are living there, that could supplement. You know what I'm saying? There's so many things that are available to you, you know, and even if you just on a minimum scale, you know, the average appreciation rate here in Houston is usually somewhere between 3 and 7%, right? So let's say 5%, cut it down the middle. Even if you appreciated 5% every year, or even let's not even say every year, let's say half of those years, okay? You appreciated at 5%, your house is worth more than when you bought it. Yeah. So you already have a growth, plus you already paid it off. So you got all that equity to use towards that supplemental income, to use towards that, you know, extra income, rental income, whatever it is that you want to do. I just think it puts you in a better position to be as independent as you can be. You ain't got to worry about nobody else's money. You ain't got to worry about putting a strain on your kids or any family in regards to monetarily. You know what I'm saying? Because you got your own. And I think that would make the transition much easier in many families is if I at some point needed that, where I could come in and I got some money that's coming with me that takes care of me for the most part. You follow what I'm saying?
Of course.
It would definitely help the battle. Plus, you know, I still got to go. I got to wear my gear still. You know what I'm saying? I still got to be shopping. I don't care how old I am. I got to still be looking a little clean. You know what I mean? In regards to what I do.
Oh, yeah. And, you know, the thing is, you're saying, what you brought up a good point about the reverse mortgage, which is a great retirement option because it provides for another paycheck. For you to be able to get outside of Social Security. It just adds to the actual, you know, and again, you still wouldn't have to, you know, kind of pay for anything. Just, you know, it would just be an added income that would be so beneficial, and especially when you're talking about your older years. You definitely don't want to be 70 something. And you know, sometimes things just happen. You just, you know, just get the short straw, right? So, but ideally, if you can prepare for it now, you don't want to be the 70 or 80-year-old guy still walking around trying to work at Home Depot or Lowe's or something like that, trying to actually do something just because, you know what I'm saying, you got to figure out a way to survive in life.
Yeah, or you doing that because you just need interaction.
Yeah, you know, or you just need,
like you don't need the money, but you're just doing it.
but you rather be there on your own will
On
than
your
to be
own
there
terms,
forcefully. You know what I'm saying? You know, you rather be there by choice than by force. You know what I'm saying? Is the biggest thing. So at the end of the day, you know what I'm saying? If they start acting a fool at any job, and I'm not ragging on Home Depot or Lowe's, but any job, for that matter, you know what I'm saying?
You
If
did
you
point out Home
you could
Depot.
just be like, look, dudes, I'm out. I ain't got to deal with y'all stuff. You know what I'm saying? Like, I'm set. I'm just here because, you know what I'm saying, I need a purpose to wake up every morning and go do something besides watching TV and playing golf. That's a position that you want to kind of set yourself in. And then the other thing that you said is, with that 5% appreciation, you're outperforming any inflation that's coming along out there.
Mm-hmm.
So at the end of the day, you know what I'm saying, you're putting yourself in a beneficial situation.
Yeah.
By owning.
Look, we're supposed to be talking about something else today, but you know, we get to talking and we just go down the rabbit hole. Look, we ain't even did the introduction or nothing. People don't even know what they
just went straight on into it.
So look, I'm gonna slide it in here real quick and we'll say welcome everybody to Real Talk with a Realtor and a Mortgage Guy. Got my guy Corey Smith with CMG Financial on here, and of course you got Walter Davis of the Walter Davis Real Estate Group and Keller Williams here in Spring, Texas. And I figured I'd give him an intro somewhere in there. We done got already into the conversation, but you know, this week we was gonna talk about a Q&A. You know, I got some questions.
That's right.
I caught some questions off of Instagram, and I got a lot of them, but we're gonna kind of run through them. I took out just the 10. Because I figured, you know, me and you can get into some of these answers.
Yeah, this can take a minute, you said, to go through it.
now, I have had the benefit to look at these questions before, so they're coming off the top for you, which would be good, because I always like your just real talk. When it comes
that's the authenticity of these answers. I have not heard or seen the questions yet.
That's right. So I just like to keep you on your toes, man. Make sure you still you got a little bit of movement there. You know what I'm
saying? Hey, I need that. I need that blood rush. You know what I'm saying? It reminds me of back playing sports. You know what I'm saying? I need that blood rush. I gotta have it.
That's right. So let's go into this first question here. And I got my handy dandy notebook. Y'all can't see it there, but I got my little notebook with all my notes in it that I be taking. But the first question, which we talked about last week a little bit, but it says, can you buy a home with no money down? I got an answer to that, but I'm gonna let you hit it first.
Gotcha. We have to be real careful about the direct definition of no money down.
Yes.
Because, you know what I'm saying, there's a big misconception out there that for, you know, VA loans and things like that, and in other programs, that there's a no money down option. Now, there is a no down payment option that you can combine with a first-time home buyer program or a down payment assistance program to be able to get your down payment covered for you. But there still will be money out of your pocket because you still have to calculate closing costs and you have to calculate those prepaids inside the money that you have to bring to the table. And for those of you that don't necessarily haven't watched some of the earlier videos, those prepaids come from us setting up an escrow account. An escrow account is a savings account that we actually set up for you so that we can be able to take care of your property taxes and your insurance at the end of the year. So typically what we're going to do is we're going to collect 3 months up front for your property tax, and we're going to collect 3 months for your insurance up front. And we're going to slide that into your savings account or your escrow account. And what we're going to do is at the end of the year, if your property taxes or your insurance happens to go up from what it was last year, we have that cushion in there to be able to get it taken care of. And we're not busting you over the head talking about your payment's going to go up because we need you to cover up this shortage that you have inside the escrow account. So my answer is this, is that it depends on what your definition is. There's a possibility of having no down payment by having that taken care of by a down payment assistance, a first-time home buyer program. There are opportunities to have kind of no money out of pocket, but the numbers of the deal just have to fall right. And it's a less than 1% chance that that's going to be able to happen.
Mm-hmm. That's a great answer. My answer is no. There ain't no, I'm just playing. I would concur with what you're saying there. I think it's I think, you know, it's kind of like what people say about rent option. You know what I mean? The term rent option and lease option. Those are old terms that were used back in the day. You know what I mean? I mean, you go to the, you know, you go to the 80s and look at Carlton Sheets. I remember his info program had a no money down program and how to buy other properties and stuff, investment properties through it. And but this is what I would say to the average consumer. The average consumer is going out to buy a house. What my goal is on the realtor side is to limit the amount of money that you are coming out of pocket if possible. So is there ways that can help to leverage some of that money? Yes. You know, if we can work with the seller and maybe get a seller concession, that might help towards some of your costs. You know, with a down payment grant, that can help towards some of your costs. But at the end of the day, you are going to come out of some money because you're going to need it. You're going to need it for inspections. You're going to need it for appraisals. You're going to need it for surveys, possibly. You're going to need it for prepaids, as Corey went over. And then, of course, you're going to need it to move. You know, it ain't nothing like you closing and you're like, well, how am I going to get this truck to put my stuff in? You know what I mean? You're going to need it to actually move as well. So I would say, I wouldn't use that term, but I'd say in the same agreement, there's ways to limit the amount of money you can use. Let's go to question number 2. Question number 2 is, we were just kind of hitting this. Interest rates are going up. What should I do if I'm not ready to buy now, but I want to get a good interest rate? You hearing me over there?
Hold on.
Oh, look, your technology is well, I'll tell you what, while he's
and we back.
Oh, look, I was just about to say, while he's technologically challenged, I was going to go ahead and answer the question. But since you never heard the question, let me go ahead and recite the second question, number 2.
All right, what you got?
Question number 2. Interest rates are going up. What should I do if I'm not ready now, but I want to get a good interest rate when I buy a house? That's a nice loaded question.
Nothing that you can do besides, yeah. So there's absolutely nothing that you can do about it right now. Only thing that you can do is try to hurry up and get yourself together so that you can be able to take a look. That goes into the situation we was talking about earlier. Even if interest rates creep up a little bit and you can't get the same rate, the biggest thing is they're still going to be at all ultimate lows. You know what I'm saying? So they can possibly still creep up. So it's never too late.
Yeah.
Purchase a house. If the interest rate is 3% or the interest rate creep up to 4%, the biggest thing is to be able to get inside a house. It's not going to hurt you. What's going to hurt you more than increasing interest rates is for you to continue to rent.
Yes.
So what you want to do is you want to be able to purchase a house. But now there's nothing that we can, the reason why I say that there's nothing that we can do is because we can't lock rates until you actually under contract and you're ready to actually purchase a house.
Mm-hmm.
So in the front, you know what I'm saying, just to be able to take advantage of those low rates, you can't be like, hey, let me lock in right now. I think I'll be ready in 6 months. That won't happen. The biggest thing you can do is be able to get your credit, do whatever it takes to get yourself ready the fastest way possible, and then be able to take advantage of rates before they start to really, really, really creep up.
Yes, good, great answer. How I would answer that from a real estate standpoint is good is subjective. So we need to change the mindset a little bit. And I wouldn't want you to sit there and look at the number of the interest rate and really be worried about that. Because at the end of the day, the right time to buy is the right time to buy. You know, if you're fixing some things and getting some things in line, then the right time to buy isn't for you right now. You're getting ready. And the right time to buy might be 6 months from now or 3 months from now. And at that point, the interest rate is good, no matter what the interest rate is. Because at the end of the day, it's about my team finding the right house that fits within your budget and within the cost of course, working hand in hand with the lender, like Corey is working hand in hand with them and making sure we have the, right amount of borrowing power. Okay, and I'll give you a quick example. He says we can buy a house at $200,000. He's going to base it off of an average interest rate in the market at that time. You know what I mean? Mm-hmm. And say your estimated monthly is going to be about this. Our job is to find that right house that covers all your needs and wants and put you in there. So really, being an interest rate watcher is not to your best advantage, because really the best time is the best time. The interest rate is subjective. You know what I mean? In regards to good or bad, or, Now, if you bought 10 houses and you're a $1 million buyer, different story. You know what I mean? Because we're talking on a whole different level about different things. You're comparing that to your finance and your stocks, your portfolio, so interest rate numbers play a different role. But for the average buyer, the best time is the right time is the right time, Question number 3. I'm a veteran. What is the difference between a VA loan and an FHA? And I'm gonna throw in there conventional loan. So basically asking, what's the big deal? What's the difference between the VA and the other ones we hear about?
No down payment. The biggest difference between the two is no down payment. And besides the obvious, which I'll just go ahead and state it, you have to be a veteran, or you have to have a veteran on a loan for a VA deal. You know what I'm saying? On the FHA, not so much. Now, the other question that I've actually gotten is that, you know what I'm saying, if you're a vet, can you still do an FHA loan? And you absolutely can. If you're still a vet, it gives you the option to do a VA loan, but you don't necessarily have to. You can still have the option to do an FHA or a conventional loan, just depending on your situation and what you think is best for you. But VA loans, from a loan perspective and a guideline perspective, is the best loan out there. In terms of what kind of benefits that you actually get. Every benefit I can't necessarily go through now, because every benefit is not going to actually pertain to every single VA loan or every single deal, every single situation. But the biggest thing to notice is that for no down payment, there's no down payment for the actual VA loan. For the VA loan, there's no mortgage insurance. There's mortgage insurance for FHA, there's mortgage insurance for conventional. For FHA and conventional, the mortgage insurance differs depending on what your actual credit score is. Now, similar for the both of them is they both kind of have an upfront fee that essentially gets rolled into the loan. For a VA deal, you have what's called a funding fee. And then for FHA, you have what's called an upfront mortgage insurance fee. Typically, you have the option to pay that up front, but of course, everybody's like, hey, look, I want to buy the house, come to the table with the least amount of money as possible. So if that's the case, then that money just gets rolled onto the loan. That's why when you do the calculations on an FHA loan, where you're just like, hey, look, man, why is my loan amount so high? And I'm putting down 3.5%. Like, this loan amount is not right. Well, you're not actually calculating in that upfront mortgage insurance that's being rolled on top of it. That same thing is not conventional. Conventional does not have that. The other thing is this: FHA is 3.5%. Conventional could be as low as 3%. I actually have no idea where people are getting this from, where conventional you need to have 20% down, which is far from the truth. And I have no idea.
That's old school thinking.
Oh man, it's like, I heard it was 20%. I'm like, where are you getting this from? And nobody seemed to remember.
Yeah.
Nobody seemed to remember. Oh man, I can't remember where I got it from. So
their cousin told them. Their grandfather told them.
Or their grandparents told them. Their parents told them whatever. You know what I'm saying? Because they bought a house 50 years ago or something. It could be anything.
Yeah.
But those are the biggest differences as far as the VA, the FHA, and the conventional. And the biggest thing people need to know is just the down payment minimum requirement for each one is the biggest thing that's the difference between them.
Well, and I'll tell you, from a real estate side, there is no difference. Whether you got a VA loan, FHA, or a conventional loan. I will say, from the perspective of the selling or listing agent and their client, in many cases, VA loans and FHA loans kind of get a little bit more stringent. You know what I mean? I guess the nice way to put it is because there's some more requirements in the inspection part of it in regards to when you're dealing with an FHA and definitely with a VA. Working with our veterans, we got to make sure that they're taken care of. So there's definitely some additional stringent guidelines in regards to the inspections. So sometimes that plays a role, but a very minimal one. Okay, I don't want anybody to kind of get nervous or anything because they got a VA loan. At the end of the day, the right house is the right house, and I just believe that. I believe that if we didn't get one, we got another one, and the other one was better. You know what I mean?
Oh, yeah.
So let's go ahead. Question number 4, which I got, says, why are homes so expensive right now? And I'm scared I won't get a good deal. So I'm gonna hit that one first. Is the reason why, you know, again, when we use these words like this, it's subjective. I mean, what are we basing expensive on? Are we comparing the cost of a house today to the cost of a house in 2005 or 2010 or 1980? You know what I mean? If I was a person that bought a house in 1980 or 1990 and I look at the houses now, I would probably think they're pretty expensive in comparison for the same amount of house. But this is where I would really lean in to say, you got to remember about supply and demand. You know what I mean? We're in a strong seller's market. So, and what that means to the average person is that basically there's more buyers than there are houses. Okay. And when that happens, that means basically the demand. I mean, if we were talking about Snicker bars, right? Yep. And everybody loved Snicker bars, but they only made 50 Snicker bars. But we got 2,000 people that want a Snicker bar. Everybody can't get one. So what's going to happen is the person that owns those 50 Snicker bars is going to drive the price up because they're going to try and maximize their potential in regards to profit. So there are some rules and regulations that kind of keep it tapered, right? But at the end of the day, you know, this is what I believe as an agent when I'm working with my clients, is the appraisal's always going to tell you the truth. Okay, so I don't care if we've got it priced at 400,000 or 700,000 or 300,000. If the appraisal comes back 150,000, that's how much that house is valued at. Okay, right. From a lending standpoint. Now you got to determine if you want to pay that extra to get it over the top. So, you know, in a general sense, it's about supply and demand, but I also would tag off and say it plays a role on what you're buying, where you're buying it. You know what I mean? All these types of things play a role. Geography is a big role. Am I buying in the Heights? Am I buying in Spring? Am I buying in the Woodlands? Am I buying in Magnolia? You know what I mean? Though it might be the exact same house, all of them have different variables that play in a role of, you know, how close are we to shopping? How close are we to highways? How close are we to workplaces? You know, how close are we to the beach? You know, there's just so many variables that come into play. So I'm gonna leave it with, like I said, it's subjective when we really say, and that's not me trying to toss off the question, but I want everybody to understand that at the end of the day, it comes down to your personal budget, your personal buying power, and what your needs are. Because if I go to buy a house for myself, really tell you the truth, as long as I'm within my budget and I'm buying the house I want in the location that I want it to be in, you know what I mean? It really don't matter whether or not the media or the news or the headline says houses are expensive right now. I'm living in exactly what I want to live in. And that's kind of my thought on the process. What you got on that, Corey?
So the biggest thing I would go back to is I would go back to your original point where you talked about the actual value of property now, like, you know what I'm saying, in relation to what it was previous back then. That just hammers home the point that we made earlier when we were sitting here talking about, imagine if you would have bought a house back then and you could sell that house now. Like, imagine the amount of money that you would actually be able to make on that on a fairly short period of time, because houses is flying off the market now. Even the fixer-uppers are falling flying off the market. You know what I'm saying? Because people are getting so hungry to get in on this craze of low interest rates and low demand. But the problem is that, you know what I'm saying, they're finding it difficult to be able to find a house and actually negotiate a deal. The great point, the other good point that you had is it comes down to supply and demand. So when you have what's in high demand, you're gonna try to milk it for as much as you can. So you're gonna go up on price that you necessarily couldn't get at another time. So your prices are gonna end up going higher. So you're gonna end up and people are gonna pay that just because they know of the market and they want to be able to take advantage of getting inside a house. So the biggest thing I would say is, in order to answer that question, and you pretty much hit the nail on the head, is it's just supply and demand. That's why. That's why it's supply and demand and inflation. The property is going to continue to go up and get more and more expensive. Are you going to wait for another 20 years to be like, man, prices is expensive again, right? Like, you know what I'm saying? Like, man, it was cheaper way back then, 20 years ago. Like, you know what I'm saying? Are you going to get in the game, or you going to wait and have that same reaction 20 or 15 years from now?
Yeah.
Like,
look, while their friend is cashing in, they're like, man, I just sold my house. I got $50,000. I'm buying this other house. You know?
I'm buying this other house, $350,000, and then you the friend that coming over hating because you didn't get in the game back then. You know what I'm saying? You didn't take advantage back then.
Yes. Here's a good one. Are we about to have another market crash like 2008?
No, I don't think we'll ever in life have another market crash like it was in 2008. And I think a market crash is a little bit of a over dramatic. Yeah, it's a little bit of exact terms. Now, do I think we're going to have a market correction? I do think that's coming. And I think the stock market is going through a little bit of a correction now because, I mean, goodness gracious, that thing started tanking for a second. But there are corrections that are going to happen. I mean, everything is cyclical. Now, what's going to actually be able to cause the actual correction? Nobody actually knows. I don't necessarily know yet. I think as of right now, it's going to continue to rock. It's really going to continue to rock. And I think until they start to actually increase rates coming from the Fed, I don't think it's going to start to normalize a little bit. And I think they're keeping their eye on it, close on it, to kind of see what the market does. And right now, I think with this whole COVID thing, the housing market is kind of a little bit of the backbone of what's happening now. Because it's so many different industries and so many different jobs that's being affected by the real estate market doing so good. And I think it's not only helping the job growth, it's not only helping the GDP, it's helping a whole bunch of stuff. So long story short, I think a crash is over dramatic. I do think a correction is coming. I don't foresee it coming anytime soon though, but you know, it's all prediction.
And I would agree with you on that 100%. And how I would add to that is what people need to understand is the difference between a 2008, 2007, 8, 9 crash and this one, and what's been happening here is I kind of say the 2008 crash was created, you know, in a way, just through bad practices, bad business practices, bad different aspects of it. It was going to happen at some point with that. This was kind of like the same thing as an unpredictable thing that happens with the pandemic, okay?
Yep.
And I think that, because if you really tell you the truth, if you go back to the last 4 or 5 years, we've been on this rise in real estate anyway, okay? Right. And this last year was projected to be as good or better than the year before, just like this year is projected to be better than the year before. We still were hitting numbers, record numbers out there. I say all that to say this, is that to understand the crash or, you know, I tag off and say one other thing people have asked about is foreclosures. You know, are we about to have a whole bunch of foreclosures? No, we're not about to have a whole bunch of foreclosures. Are we going to have some? Yes. I mean, just like in any given quarter or month, we generally have some, other than what the feds have done in regards to holding off foreclosures and forbearance and all the stuff that we put in play here. you know, it slowed it down. And yes, we will get some, but not like 2008. That was a whole different story. You follow what I'm saying? So I say all that to say this. And the reason why we won't get it, because so I know the next question somebody's going to ask, well, why not? It's because people have more equity in their house. You know, people weren't, you know, back then people were taking out money out of their house to go buy speedboats and jet skis. And when the crash happened, they had no equity. Yeah, they had no liquid, they had nothing. And so it just compounded the problem. Whereas now we're not there. I mean, I got stats that I'll show in some clips later on that could show you that, you know, the average person that owns a property, they 30% in equity. They got 30. So basically at the end of the day, and I'm sure you can attest to this, you probably saw more refinances last year than you've seen in a while. You know what I mean?
100%.
And that's because people have money in their property. So that really they said, okay, it's time. Let me do our personal correction, auto financial correction. And they refied and they adjusted their thing to get them through the pandemic portion of it. So I know I kind of went the long way around that, but you know, on a big scale, go ahead.
But to add to that, you know what I'm saying? I think at that time you had the top financial experts and advisors and people that were actually making the rule being financially just irresponsible. You know what I'm saying? And then some of the rules and stuff that they had. And then you know what I'm saying, you know, there's a little bit of truth to the movie. I believe the movie is called Wall Street.
It's called The Big Short.
The Big Short. The Big Short. And there's a little bit of truth to that, to where, you know what I'm saying, things get so far out of whack, there's no pulling it back. Like, you know what I'm saying? Once that ball started rolling, the people at the top saw it coming because the default numbers had to start going up, right? And you can rapidly see it increasing. And when you see these numbers go up, the owners of or the CEOs of Fannie Mae and Freddie Mac and all this other stuff, they see it coming. But it's just like, this is too big of a monster. What are we going to do? There's nothing that we can do at this point. It's already taken a life of its own. But now, you know what I'm saying, I think the actual big bosses, the higher ups, they're now being more responsible because they see what happened to those CEOs. Those CEOs had to be held accountable for those mistakes. And they don't want to end up like that. So I do see it from a lending perspective, and then seeing the back engine of this stuff. I do see it where they start to see numbers increase a little bit as far as default rates, and they start to change guidelines to pull the reins back a little bit. Then they'll let it go. They'll be a little bit more lenient. But as default numbers start to go back up, then they'll pull the reins back. They'll change the guidelines again. So it's a fluid thing so that they can keep a hold on the market, and so that we don't end up running into what we ran into in 2008, 2009, whatever.
Yep. Some numbers you won't like this one too. I got a couple more. I'm trying to hit them here. I'm trying to hit them and speed through them because we be talking. We be going.
We can go on them. Yeah.
I want to buy a multi-family home, live in one while renting the other three. Is this harder to get a loan for? Now, I will say, I'm just kind of hit on this one real quick, and I know you're about to answer real quick.
I was about to hit that one.
You know what happens is a lot of people seeing a lot of these videos about it, investment strastrategies, techniques, and things like that people are doing.
Hacking and sorts of
stuff.
And
I'm game, no problem, I understand. But, in the big scheme of things, from the real estate side, I would say, is that the smart move for you as the individual? I'm not dogging it one way or another. I'm just saying, is that the smart move? Because at the end of the day, when you buy a quad, let's say, multifamily, I got 4 houses, they're attached, you know what I mean? And I'm living in one. Do I really want that neighbor that close? You know what I'm saying? Like, there's also things that I think you need to think about in the big scheme of things that are just not on the investment side of it, of I'm gonna buy this, rent this, and then they're gonna pay my mortgage. You know what I mean?
Right.
That sounds great.
Right.
You know what I mean? Until you got somebody in there and they stop paying rent, or they're bad tenants, or you know what I mean? And because you got to keep in mind, you are now a owner You are at least you're a home investor in a way at this point. And so now you have to you're just not buying your house, you're buying an investment property, and you got to now manage these 3 properties to make sure that they're done right. So there's certain rules and guidelines that come into play for you as well. But I'll let you answer the question on whether it's harder to finance that one or not.
So it's not hard. It's not hard to finance it. It just depends on which program that you're actually going to go with, and depending on how many units you're actually looking to do. So in terms of an actual conventional loan, you're looking at having to put down more money if you're choosing a 2 or 3 or 4 unit, whatever the case may be. The down payment can change on you, and it could be all the way up to 25% if you're looking at a 4-plex in some situations. But then if you're looking at FHA is a little bit more easier to where, you know what I'm saying, you actually be able to get in with 3.5%, considering that the circumstances and everything is right. Now, the theory and what looks good on paper necessarily may not be good in reality. So you definitely want to make sure that before you take on a project like that, you know, people talk about how they've done it successfully and all this other good stuff. There are several other factors that they may not be adding into the equation, or several other things that happen that, you know what I'm saying, they may not be, you know, kind of disclosing it all because they want the fame and glam of everything, you know what I'm saying, everything went well for me. Like I'm balling right now, you know what I'm saying? I'm doing this thing or whatever and nothing went wrong. So sometimes, you know what I'm saying, you can struggle with people actually being 100% transparent about their situation. But you have to understand that when you actually get into a property like that, like you're essentially a homeowner, but you're a landlord as well. So you have to make sure that, you know what I'm saying, you prepare yourself and you know your strengths and you know your weaknesses. If you're a sucker for a sad story, a sob story, being a landlord is not what you want to do. Now, that's not to say that you can't be a landlord. You can be a landlord, but just make sure you calculate into your numbers that you're going to hire a property management company. The property management company is going to be the company that actually collects rent. They're going to be the bad guys for you. You don't have to be the bad guy. So you can act like, you know what I'm saying, you a tenant like the rest of them. Oh, you know what I'm saying? You know, people come to you with sad stories, you know what I'm saying? You ain't got to worry about it. You can just let your property management company be the bulldog for you. But that goes back to you understanding your strengths and weaknesses. It's going to cost you a lot more money to be a terrible landlord than it is for you to pay a little bit extra money for a property management company in order to collect those rents and do everything for you. So at the end of the day, you know what I'm saying, it's not harder and it's not any more harder than actually being able to buy a 1 unit, but it's a little bit more complex as far as the things that go into it, the things that's required, we ask for, so on and so forth, and go from there.
You didn't answer this question before, but I'm gonna hit you with it again and let you go ahead and hit it real quick. It says, what is mortgage insurance?
Mortgage insurance. So mortgage insurance is essentially your premium that you're paying to protect us as a bank in the case that you default. If you default, essentially it's an insurance policy that we're gonna get our money back. We ain't worried about it because, you know what I'm saying, that's our protection. You can default if you want to, we're gonna still get our money, and then we're gonna take it and lend it to somebody else.
Okay, I bought a home before. I only got 3 more questions. So look, yeah. I know you got to get back to, thank you for your time, of course. Look, I got a closing going on about an hour. So look, we got to run through these.
We got to wrap this up. Yeah.
I bought a home before and used my bank to get a loan, and also bought a home from a for sale by owner. Why should I use an agent and a loan officer for my purchase? You want to hit that first, or you want me to hit it first?
It's on you.
I'm gonna hit it first then. I'm gonna hit it first then, because I always like to give the common example, right? I think the best way I can describe a loan officer and a real estate agent is like if you got charged with a crime, okay, and you go into court and you sitting in front of the judge, are you gonna sit up there by yourself and try and talk to the jury and kind of go through the whole trial without no representation? Most people will say no. Now, and I'm not saying that every person would say no. There's some people that are capable of doing that. That, you know, they were former attorneys. You know what I mean? They worked in the appellate court for 30 years.
Yep.
But at the end of the day, you know, I think it's vital to have representation. Someone that's going to look at the paperwork and look at the stuff that you're not looking at, that you're not focused on, that's in it every single day, that deals with a variety of different situations, has a lot of different experiences, because you never know that one time you might come across something that they've ran across in another situation that they can give you insight on. So, you know, I'm not saying with technology, look, let's keep it real. Technology, the way technology is today, people feel like they can do all this on their own in many cases. I can go on to so-and-so site. I ain't gonna even name the site, but I can go on to what's the name site. I can find my house. Then I can go on to this other site and they can give me a loan. And then all I got to do is just wait. How much money are you leaving on the table though? Because we can do stat after stat after stat after stat after stat that working with a real estate agent, first off, is going to, if you're a buyer, is going to save you money, okay? And if you're a seller, is going to get you more money for your house. That's just a fact. I mean, I can give you a million stats about it. Working with a personal loan officer also gives you insight and saves you money because they're looking at programs that you might not even know are available, but they see it and they know it every single day. So my long short answer is you wouldn't go to court without an attorney. You wouldn't go and have surgery on yourself. Oh yeah, just all y'all gotta do is give me the anesthesia. Let me go ahead, I'll do it myself. You know what I mean? You're gonna bring in professional doctors to do that, CPAs for your account. The same way I believe about realtors for real estate and mortgage guys like my guy Corey here for loans. But that's my take on it. What you want to add?
So at the end of the day, you know what I'm saying, the biggest reason that you want to be able to use an agent and a loan officer that you have a personal relationship with, or that is on a team with your actual real estate agent, is simply for the experience. The experience that they're bringing to the table is actually going to save you tons of headache, tons of time, and tons of money at the end of the day. So you know what I'm saying? When you actually, like you said, you go to court, when you go to court, you want that lawyer because a lawyer does this on a day-to-day basis. He knows what works with judges. He may or may not have a personal relationship with the judge, or, you know what I'm saying? He may not, I mean, you know, it's no telling what the political connect could be. But you know what I'm saying? At the end of the day, he knows what you can and what you cannot say to the jury in order to get you off, because it's through experience, because he does this on a day-to-day basis. If you going in brand spanking you don't know half of what that person knows. So then therefore you can step in a dog pile of doo-doo and not even know.
I know what you was about to say.
yeah, you know, I'm getting ready to let it roll. But you can get ready to be doing that and not even know it. You know what I'm saying? So like, it saves you so much time. It's so many times that I actually talk to clients and I'm like, hey, have you guys, because your situation is this, have you guys thought about A, B, and C? And they're like, well, man, I haven't even been told that. I didn't even know I had those options. So then now you know those options. They may not be good options for you. You may not want to take advantage of them, but at least you know what your options are and you can take advantage of it. And it could save you. It could save you money. It could save you money at the closing table. Like it could save you money from what you're getting back from the actual sellers, or the sellers trying to put on you something that they should be paying for, or it could be anything, right? So at the end of the day, the biggest thing that you're paying for is the experience. And I say paying for, but you're not really paying for anything. For a real estate agent, for you to represent the buyer, you ain't paying for nothing.
Yeah.
The seller's taking care of that. And then from the bank standpoint, you're not paying my commission. My commission is coming from the bank that I represent. But at the end of the day, you still want to put yourself in the best situation to where you're getting in the best loan, you're getting in the best house, and you're doing it with the least amount of headache as possible.
Yep, yep. This one's a quick and easy one. It says, how long does it take to close a home from start to finish? I'm gonna hit that one real quick.
You got it.
It really depends on the scenario. Everybody's scenario is unique. And let's say on the average person, it takes about 30 days. If we was to get a contract today and set a closing date and everything runs smooth, you know what I mean? You're talking about 30 days, 21 to 30 days, somewhere in that frame. Now, in some cases, if you have some challenges, it might be 3 months. It might be 90 days, because we might have to fix some things on the credit in order to get you in the position to then get the pre-approval to get you a loan to then go find a house. You see what I'm saying? So it varies depending on each person's unique situation, which I always try and keep in hand. I know Corey does too, because everybody's different, and we want to make sure we maximize your situation, not just put you as a number and say, okay, these are all the same. You know what I mean? But I would say from an average, you're looking at somewhere between, I'd say lowest would be 21 days and the highest would roughly be about 45 days in an average scenario.
Yeah. So I always tell people, you're saying I can't necessarily say it's a loaded question.
Yeah.
What it is. I know from the standpoint of, like you say, you get on a contract, we're about 30 days.
Yeah.
We're about 30 days to be able to close. But I've seen people find houses as short as, less than 1 week. Yeah. And I've seen it take 3 or 4 months in order for somebody to try to lock down and find a house. And for several different reasons, you know what I'm saying? Because stuff happens or whatever. They get knocked off course from what they're seeing, issues with whatever the case may be. But at that point, you know what I'm saying, there's no way I'm able to know when you're going to find the right house for you. So then that's the part that kind of, is the variable in the situation. But from the time that you actually go on a contract, with 30 days before you get those keys.
Yeah.
If not less.
Look, I'm down to that last question for you. The last question for you is, this is a good one. I rent for $1,200. Can I find a home for the same amount of rent?
Yeah.
Yeah, that's what I was about to say. Yeah.
No more needs to be said. Yes.
Yeah. Yeah. You know what I mean? But right? That's the reason why we're talking to y'all right now. Is we're talking to you to let you know that no matter what your scenario is, we can find it that works. Now you got to understand. This is the one caveat I'd put in there, right? We're not gonna get the HGTV house.
Right.
Okay.
Because as long as your expectations is proper.
Exactly. Because they're looking at $1 million agents saying, oh, well, I can get this house for $1,200.
Right.
No, that's
I want a house like
they
that.
do say $1 million agent for a reason. Okay. But this is the key I would put on it is we're gonna find the right house that fits your needs and is in your budget for you at that $1,200. Now, if you got some flexibility either way, it just opens more options for you, But yeah, we can find something that fits if you're renting for $1,200. Find you something for $1,200.
Hands down. As long as your expectations is proper.
Right.
Then you'll say I'm pretty sure you can find them something to get into.
And then I negotiated like a beast. I call myself a gladiator in negotiations. I go in like Russell Crowe.
Hey, you host classes on negotiation.
I think that the funny part about this, and I'm gonna keep this short, is that the people that are selling their house want to sell their house. People that are buying a house want to buy a house. So the key to negotiations is finding the win-win on both sides to make it work. You know what I mean? And that's really what it comes down to. So, what you got? What you got to end it off today? We've been talking about a lot of stuff today. Questions. And how'd you like that Q&A? That was kind of cool, huh?
That was cool. I loved it. I think we tapped on a lot of things today. You know what I'm saying? People got a lot of information that they can take back. And I'm pretty sure you're saying it's probably gonna lead to more questions. And we like those.
Yeah. Well, hey, as always, I appreciate you. You know what I mean? Taking out a time every week to do this. And I think we're giving a lot of insight to people, and we're just going to keep it moving. You know, next week I might bring on another agent. I might bring a younger agent on next week and have all three of us talk.
Let's do it.
And kind of get their perspective. Because, you know, we the old guys in this business. We got all the experiences. And, you know what I mean? But it's kind of fun to sometimes see. I remember when I was new. I know you remember when you was new, and it was like, you know, like, man, all this stuff, you know? And now we just we know how to navigate, you know?
Right. And then, you know what I'm saying? And then it's real estate. So when those surprises and those bumps and those hurdles pop up, you know what I'm saying, we don't get so frantic because, you know what I'm saying, we already know anything can happen in real estate. Yeah. Any surprise can pop up.
Well, and you know what I always say, that there ain't no emergencies in real estate. You hear me? I said, there ain't no emergencies in real estate.
The deal ain't done till the ink drop.
That's right. So, but hey, man, like I said, I always appreciate you. Of course, that's Corey Smith with CMG Financial. And make sure you guys look in the notes. If you guys got any questions, don't hesitate to call him directly. Of course, I'm Walter Davis. My information's in the notes as well. And if you got any questions for real estate, call me. We'll team up together. We'll make it happen for you, whatever your scenario is. So we'll see you next week. And like I said, Corey, hey, tell the family I said hey, and I'll see you next week.
Likewise. Sounds good.
All right, boss.
All right.
Later.